Hey everyone, and thanks for jumping back into the Cryptoverse. Today, we're going to talk about Bitcoin, and we're going to be discussing the risk metric. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, the risk metric is what I use to navigate Bitcoin. Obviously, we've talked a lot about short-term price action and where that may take us. But at the end of the day, and I've said this basically since 2019, at the end of the day, it's impossible to predict where the markets will go. And so rather than constantly worry about where the market is going to go, I think the successful strategy for Bitcoin is to have a plan no matter where it goes. So, for instance, right now, the Bitcoin risk, according to this model, is 0.623. Now, there's going to be other models that exist out there that might actually provide a slightly different risk level. I actually have another risk metric on this website that's actually based on other things as well, including on-chain data and social data, as well as some other price data. But this is the risk metric that I've been using since 2019. In fact, if you look at the channel back in 2019, we talked about this very risk metric. So I believe it was created somewhere over here. And when it was created, we saw it test the lower bound of the risk metric. We saw it go all the way up to the highest band in the risk metric, that 0.9 to 1 risk band in early 2021. We then saw it go back down to some of the low risk levels, and now it's back up to about 0.623 risk. And so you may be curious, well, what is one way you could navigate this? One of the way that I think about it is, first of all, trying to develop a single strategy that's going to be appealing to everyone is impossible, right? It's absolutely impossible. So, for instance, if you were to go up to someone who's maybe just out of college, they have their first job, they want to take on a little bit more risk because even if they lose it, they have theoretically decades and decades to make it back. Those people are obviously more likely to take on more risk or to want to take on more risk because they can live with the fact that, hey, if it doesn't work out, they have plenty of time to make it back. On the other hand, if you were to take this and go to someone in retirement, they're less likely to want to take on that same amount of risk. And so, what I've said before is that there is not a right answer to this. But what I think makes sense is for people to pick out what risk level they are comfortable with. Now, the first time you go through a market cycle, you might think your risk tolerance is higher or lower than where it actually is. So to some degree, it's almost trial and error. You have to actually figure out what you're comfortable with. What often happens during mania phases is that people think they are comfortable buying up to 0.8 or 0.9 risk. And then a few months later, they then actually find out actually that probably wasn't a smart decision, right? And so last cycle, just for full disclosure, last cycle, what I did with Bitcoin is I DCA'd it up to 0.5 risk. So this was back over here. I bought Bitcoin up to the 0.5 risk level. And then beyond that, as we went up into the higher risk bands, I then dynamically DCA'd out of the market. Now, back over here, when Bitcoin made this move, I actually did not primarily DCA out to USD at the time. I primarily DCA'd out to things like ETH and altcoins because I was convinced that after you get these manic blow off tops by Bitcoin that often happen in the post-halving year, you get your alt season, right? You get alt season, which everyone spends years wishing for, and then it normally arrives where the Bitcoin dominance goes down durably, at least for a few months in the post-halving year. So that was the way I navigated it. This cycle, though, I decided that I was not comfortable taking on that risk up to 0.5 risk. So as I've said on here previously, and as I said on ITC Premium many, many times, I only DCA Bitcoin up to zero point 0.4 risk this cycle. So that's just my own personal risk tolerance. And then it sort of raises the question, well, if you buy up to a certain risk level, do you sell immediately above that risk level? Now, I've tried doing that before, and it's actually quite irritating because what ends up happening is you'll pick a risk level, and then the price of Bitcoin will go over that risk level, and then it'll go back below it, and then over it and then back below it. And the point of these sorts of models are not for short-term trading. So what I've sort of said before is I think it's a good idea to develop sort of a gray region between where you buy and sell. So maybe you buy up to a certain risk level, and then above that risk, up to an even higher risk level, doing nothing, right? It means you're not really adding to your position because you don't want to keep on buying into the mania, but perhaps it's not quite to the level that you would actually want to part with any of your Bitcoin. And that way you sort of mitigate some of the unwanted effects of buying it and selling it, back and forth. And so I think that's sort of the way to go about doing it. Now, some people are quite happy buying all the way up to high risk levels. And then some people would, of course, prefer to stick to only the lower risk levels. In fact, I've actually met plenty of people over the last several years that only buy Bitcoin below 0.2 risk, right? And I mean, it might sound crazy to a lot of people because, think about it, right? If you're only buying it below 0.2 risk, that means for the most part, you're not buying Bitcoin, right? You're only buying it very select periods of time in the cycle. And then you're essentially not doing anything with it until it gets back down to that level, which often takes years. Okay. But if you're just sort of an investor that, you're not watching the day-to-day stuff of it, and you just recognize that opportunities arise in the cryptoverse every few years, and maybe you're not a diehard crypto investor, but you want to have Bitcoin in your portfolio, I think this could be an interesting way to go, right? Where you're probably picking up other things as well. Maybe you have index funds and some other stuff. And then you could say, all right, well, whenever the Bitcoin risk level goes below 0.2, that's when you get a position. Some people, there's not a lot of people that I've met that do it like this, but there's no denying that it would be an effective strategy, right? There's no denying it. This is what I'm currently using, right? Below 0.4 risk. So in late 2022, as I said on ITC Premium and even disclosed here as well, I did buy some Bitcoin. And essentially what I did was I just set some limit orders down the wristbands in order to pick it up. Now, I did not buy altcoins because my view back then, which turned out to be correct, was that the Bitcoin dominance was going to go higher and that Bitcoin would outperform the collective altcoin market. Now, I knew back then, based on my experiences in the two market cycles that came before, I knew back then that there would be a lot of pushback on that because I knew that there would be some altcoins that would outperform Bitcoin. So in late 2022, I sort of made the conscious decision that what I thought was right in my own mind was to just say, look, guys, Bitcoin dominance is going to go higher. Bitcoin is not as risky as the altcoin market. Therefore, if you're going to DCA anything in crypto, it might as well be Bitcoin. Now, there's been a lot of pushback on that because certainly some altcoins have outperformed. And as I've said before, I don't imagine I'm going to continue on with the Bitcoin dominance mantra in the following cycle, so in the next cycle. But it does go to show, right, that, hey, it wasn't so bad just sticking with Bitcoin throughout the time. And, in early 2022, I put out a video talking about, why altcoins would bleed back to Bitcoin for the next several years and why we were starting a macro Bitcoin dominance rally and that it was going to take several years to play out. And here we are, and sort of the idea was that Bitcoin would go to new all-time highs first. And here we are, right? Bitcoin's at new all-time highs. Most, but not all, altcoins have reached that level. So in this case, right, if you buy up to 0.4 risk, you end up being able to buy a lot more frequently, right? But the downside of it is that if you buy at 0.4 risk and below, you end up picking some up, a few months after major tops. Now, as long as your time horizon is several years, it doesn't really matter, right? It doesn't really matter if you picked up Bitcoin over here at 30 to 40K, as long as you weren't going to capitulate into the Q4 lows. So again, and I know I get a lot of flack for this because I will always express sort of a cautious view when it comes to risk assets, especially cryptocurrencies. But at the end of the day, the only thing I use to trade or to invest are the risk levels. And basically what it is they go from 0 to 1, right? So 0 is historically low risk, 1 historically high risk. And the issue, because someone might say, well, why don't you only sell when you go to the 0.9 to 1 wristband? Well, there's plenty of reasons for that. One of the reasons is because you don't always go there, right? I mean, 2019 was a great example where you did not go to the 0.9 to 1 wristband. In fact, 2011 was an example where you just went to the 0.8 to 0.9 wristband. So you don't actually always go to the higher wristband. But I've also had a sort of a view on the market over the last several years that I've reiterated many times is you never let a good bubble go to waste. And in 2019, we sort of had a largely unexpected rally at the time where if you were dynamically DCA selling, say above 0.5 or 0.6 risk, it would have allowed you to part with a small amount of that Bitcoin before Bitcoin essentially went back down to the lows. So that's sort of the way that you could do it. But as I said previously, right, as long as you have a long enough time horizon, theoretically, Bitcoin will eventually go up to the higher risk bands again, right? This is where Bitcoin has gone between 0.7 to 1 risk. So you can see what those look like right here. If you go just 0.8 to 1, you can see we haven't actually hit that this cycle. Last cycle, we did not go to the 0.8 to 1 wristbands until really the early part of the post-halving year, which is about half a year from now, although this cycle has certainly thrown us a lot of curveballs considering that Bitcoin hit a new all-time high before the halving. There's another way to visualize the risk metric, and that's to take the color code part out of it and just look at it like this. And here you can see, just how high some of these prior bubbles went, right? This first bubble over here went up to the 0.8 to 0.9 wristband in 2013. You basically had a double top. Both of those tops went to the 0.9 to 1 wristband. 2017, 0.9 to 1 wristband. 2021, 0.9 to 1 wristband. This was 2017. In 2019, we only went up to the 0.6 to 0.7 wristband. So far, this cycle, we've gone up to the 0.7 to 0.8 wristband, right? And we went there back in March. So definitely elevated, especially compared to 2019, but still below these prior levels over here. So again, there's not a right answer. And I think a lot of people like to say, well, there's, if you sell it and it goes higher, then, you made a mistake. Or if you buy it and it goes lower, then you made a mistake. But in reality, absolutely no one knows where the top is or the bottom is. And we're all just sort of doing the best we can. One way to visualize this as well is to consider that in the higher wristbands, we actually don't spend that much time there. If you're to look at time in wristbands, going all the way back, you can see that between the 0.7 to 0.8 wristband, out of all the days, we've only been in that wristband about 144 days, or 2.86% of the time. In the 0.8 to 0.9 wristband, we've only been there about 1.59% of the time. And in the 0.9 to 1 wristband, we've only been there 0.36% of the time. In fact, that highest wristband, we've only even been in that wristband 18 days out of the last, more than a decade of data. So it really goes to show how whenever we are in that wristband, everyone thinks that it's never going to go back down, and then we ended up getting a fairly large correction. It's difficult sort of in the sort of in the middle when you look at it like this. If you look at historical risk levels, it's sort of difficult sometimes knowing where it might turn around locally before then going back up, right? I mean, in 2019, we turned around well before the pandemic arrived, and went back down to the 0.3 to 0.4 wristband, which, by the way, is where we have historically spent most of our time, the 0.3 to 0.4 wristband. So these are all, I think, important things to consider as you navigate the cryptoverse. And as I've said before, I mean, figuring out a risk metric to use shouldn't be, that difficult. You don't have to use the one I use. There's plenty of other ones that you could use. You could make your own. They're not super complicated. Um, it's just, taking a metric, anything. I mean, it could even be like on-chain data and normalizing historical moves between 0 and 1, right? And in fact, if you were to go look at the indicator dashboard, as I said earlier, we have other risk metrics as well based on-chain data and social data, and then some more price data, and then we have a total summary risk metric, right? But when you think about it like that, I mean, you could look at other metrics, other risk scores, and kind of see, what they look like, right? You could look at if I were to just pull up the on-chain risk here, and instead of looking at the total on-chain risk, which is what should show up here after it loads, you could pick any individual one as well, right? And see, what they look like and how they ultimately go into creating a single risk metric. By the way, I've had some people ask me about the Peel multiple and why it had such a large drop in May. Because I posted something on Twitter. I know it's X, but for me, honestly, it's just Twitter, where it had a pretty large drop. This is because of the halving, right? You can see something very similar that happened in July 2016, where we had a halving. You can see something very similar in May of 2020 when we had the halving, and the same thing back over here in November of 2011. So just wanted to clear that up. I think some people were sort of reading into that a little bit too much, but that is caused by the actual halving. So definitely plenty of different risk metrics to go around. We've have several of them based on all sorts of things. And as I've said before, I mean, I think the winning strategy for crypto and Bitcoin specifically is to stick to something and to not spend so much of your time worrying about where the price is actually going to go and just saying, you know what? If it goes lower, if it goes below the risk level that you're interested in, then perhaps you'll start to buy it again. If it goes higher than what you're comfortable with, then maybe you just kind of hold off and you don't necessarily buy anymore, but perhaps you're also not selling either, especially if you're wanting to wait for it to go into higher risk levels eventually. And then if it goes up too high, then perhaps you could take some profits. But again, it all depends on what you're comfortable with. And if you look at like historical risk levels, you can sort of visualize what it would look like to buy below 0.4. Perhaps do nothing between 0.4 to 0.6, right? Which is essentially what I've done this cycle. I don't know if I said that earlier, but this cycle, basically it was, below 0.4 is fine. Between 0.4 to 0.6, I do nothing. And above 0.6, then you start to wonder, all right, well, how much higher can it really go before you get a larger pullback? And history gives you mixed examples, right? I mean, 2019 didn't even go as high as it already is, but 2021 and 2017 went a lot higher. So again, it's certainly impossible to know, and no one has the answer. But I mean, you can imagine, right? Like you pick out a risk level that you're comfortable with, buying below. You pick one out that you're comfortable selling above, and you just tune everything else out. And I think that is the way to navigate the cryptoverse in an effective manner. Basically, instead of worrying constantly about what the price is going to do, you actually just, if X, then Y. If A, then B, or if C, then D. And you just navigate it like that. Of course, I provide basically almost daily videos on short-term speculation and whatnot, but a lot of times my short-term speculations are wrong. So I do think it makes sense to just sort of stick to a risk metric, and it doesn't have to be this one, but stick to something, come up with a plan, stick to it no matter what, and don't let the narratives sort of sway you one way or another at high risk levels or low risk levels. Just stick to the data, nothing more, nothing less. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out Into the Cryptoverse Premium at intothecryptoverse.com. Thank you guys for tuning in. I'll see you guys next time.